Would you agree? Yeah. But now, non-residential or commercial real estate falls down in 39 years. Okay, is that good or bad? My answer is it's good, just not as good. Because you got to understand something. It used to be terrific when it was 19 years. When they jumped to 39 years, they did hurt lots of investors that were used to the huge deductions. But it's still good from this aspect. We're not talking about $100,000 little houses now. Now we're talking about multi-million-dollar buildings divided by 39 years. That's still a pretty healthy chunk. You get to say you lost even though you didn't. So it's still good, just not as good. Now, isn't it also true when you buy real estate? Normally, in the purchase of real estate, you buy incidental personal property. For example, if I buy an apartment building, don't I buy a whole bunch of refrigerators and stoves? And don't those things truly break down and wear out? So you get to depreciate personal property along with the real estate over 5 years. Okay, so this is current. Now watch the next part. It's today. I go out and I become a maniac, so much so that I accumulate $50,000 worth of passive activity losses. Okay, now back to something I said earlier. Does that mean I lost 50 grand? Yes or no? No, that's all on paper. It's still the same rules today as it was in the past. We're just using these tables instead. Okay? Now, lost 50,000. Watch what I'm going to do. I'm now going to take the 50,000 and as I used to do before, I'm going to go to the wall, meet the little guy named Urs. I'm going to say, hey, Urs, I got $50,000 worth of pals. Drill me a hole through the wall. Watch what Urs does starting in 1987. He puts up his hand when I get to the wall and he says this to me. He says, I'm not the same Urs that I was in 86. See, in 1986, if you came to me, I would drill a hole through the wall for any old pal. But in 1987, because Congress changed me, I will only drill a hole if you're my kind of pal. And to determine if you're my kind of pal, I have to ask you a question. You must answer it correctly if you want to get through the wall. Here's the question. What type of real estate investor are you? That's the question. And you're going to answer that question one of two ways. You're going to say, I'm an active investor or I'm a passive investor. That's what you're going to answer. If you say I'm an active investor, Urs says, I love you, I'll drill you the hole. If you say I'm a passive investor, Urs says, get out of here, you're not getting through the wall. So which one do you want to be if you want to get through the wall? Active. Okay, so now let me tell you what active basically means and I'll have you jot down some things, okay? Active means you are somebody who actively participates in managing the real estate. You got this? Actively participates in management. If you don't, you are considered a passive investor and you can't get through the wall. Okay, so now I'm going to have you jot this stuff down and then I'm going to explain it in detail. This is the next thing in your notes. This is the definition of active versus passive. Jot it all down, then I'll come back to it and explain it in detail. The goal, if you have income on this side of the wall and you invest in real estate, is to be active so that you can bring these losses through the wall against your income over here. Now, to be active, you have to meet the rules that are under letter A. And if you don't meet these rules under A and B here, what happens is you become passive. So I want to talk about passive in just a second, then I'm going to take you back to this. If you do not meet these rules and you are considered a passive investor, here's what it means. You can't take the $50,000 through the wall. Well, if you can't take the $50,000 through the wall, what do you do with it? Well, the government says, well, you still can keep track of it and stick it in your pocket on this side of the wall. Just save it. Now watch, every year, Urs asks the same question. If every year you are considered a passive investor, which means you don't manage the property, every year you'd have another $50,000 you'd be sticking it in your pocket. So after 2 years, you'd have $100,000 accumulated in your pocket, right? What do you do with it? Well, this is real estate, so here's what you do with it. Let's say in the third year you decide to take one of the little buildings you originally bought for 100, and you're now going to decide to sell it for 200,000. Well, if you bought it for 100, sold it for 200, you now just made $100,000 profit. Now, this is a positive number, and I taught you something about positive numbers. What did I teach you? They bounce over. I don't want it to bounce over. Do you have any ideas? Reach into my pocket of what I've been saving for years, and since I got 100,000 accumulated, I subtract the 100,000 I saved from the 100,000 that I made, and it's zero tax, but it all happened on that side of the wall. So what I'm saying is, if you can't use this over here, the government says you still can use it on this side of the wall. We call that a suspended loss. And the question comes up, well, how long can you suspend it? Current law says forever. How much can you suspend? Current law says unlimited. So if you have these losses, can you use them later on? And you will use them when you sell, or if these properties become paid for, now they have this rental income, you can offset the rental income so you're not taxed on that. So do you still get a tax deduction only against the income on this side of the wall? Yes. Now, most people, though, when they start off, they want to offset their income from their job or career over here. So therefore, to do that, you have to be active, which means Urs will drill you a hole. To be active, here are the rules.